Okay, good day everyone. This is DBS Group Holdings second quarter 2025 financial results dated 7 August 2025. Right, we look at the second quarter 2025 results. Pre-tax profit rose 5% year on year. Net profit increased 1% year on year. Right, generally it's better to look at year on year quarterly results primarily because of seasonal effects in the quarters. Right, so for example, in DBS I observed that the first quarter always seems to perform better than the second quarter. Right, so that's not a great comparison. Right, net profit being up 1% year on year is actually a decent result because they expected net profit to be lower this year due to the global minimum tax. Right, so they are just basically paying higher tax lah. Right, so they expected net profit to be down this year, but it's actually up 1% year on year for second quarter. That's a good result in general. Right, we look at the details behind the numbers. Right, you can see here net interest income actually dropped by 4%. Right, this mainly due to the sharply lower rates. Right, interest rates is dropping. Right, and this is already hedged. That means to say that if they didn't do some hedging, right, this drop in net interest income would be worse than the 4% shown here in the graph. Right, the negative $144 million. Right, but this is offset by the other parts of the business that's doing well. Right, fee income is up 11%, up 119 million. Treasury customer sales and other income is up 9%. Right, up by 44 million. Right, and market trading income is up by 124 million, and this is the carry looks like for the quarter. Right, because it's up by $231 million. Right. This is, however, I think more likely a one-off primarily because of the fact that the trading income, right, for this part actually benefits from volatility, and second quarter is from April to June. Alright, so second quarter April to June, April was the Trump tariffs, alright, and this was when volatility of the markets was at the highest. So I think this is why the market trading income suddenly spiked up so much by 121%. Right, it's clearly quite unusual results. Right, and I don't think this should be expected to carry on being at this level moving forward. Right, expenses rose 5%. This is a bit unfortunate because I thought using AI they should be able to drop expenses, but it looks like they still have increased staff costs. Alright, but the good news is total income and profit before tax is actually at record highs. Alright, we look at this is first quarter versus second quarter. Like I said, I generally won't put too much into it, but I just just want to talk about this for context. Right, second quarter net profit actually declined 3% quarter on quarter. So actually this quarter is worse than the first quarter. But generally speaking, their second quarter is worse than first quarter, as far as I observed the last 2 years. Right, so I don't think we should worry too much about this. Right, the numbers are not too different. The fee income part we'll discuss a bit later. Right, first half pre-tax profit up 3% to a new high. Right, this one I won't read too much into it lah. Right, so they're trying to compare the pre-tax profit because they are trying to look at it on a same basis outcome as last year. Alright, but I prefer to look at net profit because this is the real profit that they take home, and also this is likely to be the profit moving forward lah. So if we look at net profit, is actually down. You can see here 2024 first half net profit, right, is actually 5759, and this has dropped to 5721. Right, won't really go into it too much. Alright, you can see the net interest margin has been going down. Alright, but in the talk, the CEO said that actually net interest income is more important than net interest margin, because she feels that as net interest margin goes down because interest rate come down, it will be mitigated by the fact that the volume of loans increases. So looking at net interest income is a better proxy of how the bank is doing lah. I don't really disagree lah. Alright, so I think what she says has some merit. Okay, but I would think that there are some there are some question marks about this that I'll discuss a little bit later. Right, anyway, we look at wealth management again, which is the carry lah. Alright, you can see wealth management, the orange bar, right, generally is doing very well lah. It's about 30% rise from first half 24 to first half 25. Right, if you just look at the orange part in the graph. Right, if you look across quarters, right, if you look at second quarter 2025, is clearly higher than all the quarters in 2024, right, except first quarter 2025. Right, so first quarter 2025 is 724, which is the highest. right? Probably ever, and then they drop back to, actually it's definitely ever lah, right? Then they drop back to 649. So actually first quarter 25, the wealth management fee income was the highest lah, right? This in the transcript they talk about the fact that wealth management was affected by Liberation Day in April, right? So that's why there is a drop in wealth management in second quarter, and it will recover in May and June. If that is true, right, then we can look forward to wealth management actually doing better in third quarter lah. Right, so there's some positives from this. Right, so given the fact that the trading income is a one-off positive and this wealth management looks like a dip because of Liberation Day, it's likely to mitigate each other as it goes to third quarter lah. Right, so overall there's no real big changes to the result. My guess is in third quarter, right? Wealth management income and AUM record highs, right? This is great results for the bank, right? Nothing much to say about this, right? Commercial book non-interest income also doing decently well, rising 11% year on year. Again, won't talk too much about this. Yeah, first half treasury customer income up 14% to record highs, and market trading income 80% higher. But I say again, I think market trading income is a anomalous point in this quarter because of the tariffs in April, right? They have a special record slide for Hong Kong, right? Because their main markets, remember, is Singapore and Hong Kong, right? And the fee income here is the standout performance, again driven by wealth management, right? If you look at the first slide, you also realize that generally they talk about wealth management a lot lah. All right, the first slide over here, right? You can see fee income rose by 11%, led by wealth management, right? So moving on, yeah, so this is the dividend. Current price as of today, 18 October 25, is $52 at dividends of $3, right? Please note that this $3 dividend is what they expect to pay this year lah, right? It's not definitely confirmed, but I think the current sense from management is that they are quite sure they'll pay out $3 this year, and moving forward as well, they will try to keep this dividend rate. All right, at $3 payout ratio, right? Please note that $2.40 is ordinary dividend and 60 cents is capital return. That means by right is they are just trying to redistribute their capital back to the shareholders. All right, so without the capital return part, actually is $2.40 dividend, right? So that means 60 cents per quarter times 4, right? And that will give us a 4.6% yield just based on ordinary dividends. All right, is it possible for them to cut dividends in a recession? Yes, definitely possible. And I will say that given the way I read the transcript these days, it's clearly a lot less bullish than last year under Gupta, where he was very bullish and he kept telling people that we have got more money to give back to shareholders, we got more money to give back to shareholders. The tone I read from the transcript these days is a lot more cautious. They are saying that we probably can sustain the dividends we are paying out so far, right? Since even at $3, this includes capital return, it's still 75% payout ratio, right? So you take out the capital return, right? Actually, maybe it's around 60%, right? Yeah, probably around 60% payout ratio. That's my guess, right? And also they have a buyback program which where they have done about 12% off. They want to buy back about $3 million worth of stock. At least they have that mandate right now, right? They've only used 12%, right? Given the stock price performing so well, I don't think they were likely to do buybacks at this point lah, right? So the outlook for 2025 is net interest income slightly above 2024, non-interest income mid to single digit growth, return on equity to remain about 17%. This is still higher than OCBC and UOB, right? Dividend possibly likely to be stable with possible further buybacks, right? So clearly they never suggest that they'll pay more dividends anymore. So this is why I also feel like the upside for the stock is quite limited at this point, right? Or in other words, I don't think I will be buying any DBS, right? Again, not financial advice, just sharing my own personal take. Okay, profit before tax likely to be similar last year, after tax lower. All right, so I'll make this very clear. I think the profit this year will be lower than last year. All right, that means before tax will be similar, but after tax will be lower. So the real profits is lower. All right. Key risk is interest rate and FX volatility. The CEOs herself said they are price takers. That means they have no control over these two things. All right, so when these two things happen, they could lose money. right? They expect volume growth to mitigate, meaning to say interest rates come down, they expect more loans to mitigate the loss of income due to the drop in interest rates. Right? They say inflow to SG and Hong Kong is very high. All right, that means to say somehow SG and Hong Kong still doing very well lah. Right, and they also hope for new customers if the interest rate come down lah. Right, I would say that I think what she says is reasonable. However, using new customers or new loans to mitigate the drop in interest rates, I think it's dependent on whether the economy is doing well or not as the interest rates drop lah. In a recession, interest rates drop, I don't think people will be rushing out to get more loans, right? So it really depends on what type of interest rate drop situation the environment is in, right? If the environment is still relatively healthy as interest rates drop, yeah, I do think people take on more risk and take more loans, right? And probably this will be the start of a new bubble lah, right? But if it's a recession and interest rates drop, I'm not sure that people will be flooding the bank to take on loans, right? Cybersecurity, I'm not too concerned with lah. Of course, there are geopolitical uncertainties we cannot control, right? They have strengths to mitigate this risk, right? Strong liquidity, diversified income source. You can see that even though their interest income side has been dropping, the non-interest side has been holding up the income quite well, right? Proactive hedging, which is why they didn't probably go into a drop of profits in second quarter lah, which I think the other two banks are actually happening to the other two banks. They are actually dropped profits already and technology-led efficiency, which to me is a bit of a question mark. Alright, so that's all for my analysis for DBS Bank. Do give me a like, and yeah, I think